Welcome to the Poseidon Finance channel. Do me a favor and hit the like and subscribe button. Let's get started. $40. That's the number I want sitting in your head for the next hour. $40 a barrel. Not because there's anything magical about that exact number, there isn't, but because of what tends to happen when oil settles there and stays there for, 6 months, 9 months. Long enough that the people running large balance sheets stop telling themselves it's temporary. Most of you, if you've taken a macro class in the last 20 years, were taught a very clean story about cheap oil. Lower input costs, more disposable income, consumers benefit, growth gets a tailwind. There's a Bernanke speech from, I want to say 2006, might have been late 2005, where he basically describes oil shocks as a tax on the consumer. And as far as that goes, fine. But the framework has a kind of fatal incompleteness to it. It treats oil as if it were consumer input. Gasoline at the pump, heating oil, maybe airline fares. That is not what oil is. Not at the level we're going to talk about today. Oil is a balance sheet. Oil is a sovereign credit instrument. Oil is the collateral underneath, depending on how you count, somewhere in the neighborhood of $2 trillion of global debt. It is the operating budget of about a dozen nations. It is the largest single physical commodity by dollar volume traded on Earth. And when its price moves a lot, in a particular direction, sustained, things break that a textbook on consumer surplus has no language for. Let me give you a sense of scale before we go any further. At the peak in 2014, energy stocks were roughly 13% of the S&P 500 by market capitalization. Today, they're closer to 4%. Energy debt, at the peak, was about 15% of the entire American high-yield bond market by face value. The oil and gas industry directly employs, in the United States, somewhere between 600,000 and 1 million people, depending on how you count, but the indirect employment runs into the millions, especially in states like Texas, Oklahoma, North Dakota. So when we talk about cheap oil, we are not talking about a sector. We are talking about an organ. So what I want to do today is something I've been working on and off, for at least the last decade, probably longer. I want to walk you through what actually happens when oil drops to $40 and stays there. Not the consumer welfare effect, not the energy import bill arithmetic. The other thing, the thing that if you sit on a real institutional desk, and I don't mean a prop shop trading futures, I mean a sovereign credit desk at a bulge bracket bank or an emerging markets debt team at a real money manager, you see this play out in real time, but it doesn't make it into the published literature because the people who deal with it are too busy actually dealing with it. Let me give you a snapshot. February of 2015, I was in Houston for a credit conference. The thing had been organized maybe 8 months earlier when oil was still trading north of $90. By the time the conference actually happened, oil had been cut roughly in half, and you could feel it. The hotel was half booked. Restaurants near the convention center empty by 8:30. There was a guy from one of the regional banks giving a presentation, and he had this line. He said something to the effect of, "Our energy book isn't a credit book anymore. It's an option on the price of oil." Said it in front of, 200 people. The room went quiet because everybody knew exactly what he meant. That's a statement that, in normal times, you do not say at a public conference. You don't admit your loan book is functionally a derivative. But by February of 2015, the pretense had cracked. People were saying out loud what they had been whispering in November. 5 years later, April of 2020, you got the most extreme version of this anyone has ever seen. The May contract for West Texas Intermediate, the benchmark American crude, traded at negative $37 a barrel. Negative. As in, the holder of the contract had to pay someone to take the oil off his hands. That had never happened in the history of crude oil trading. The chain of plumbing failures that produced that print, the storage saturation at Cushing, Oklahoma, the ETF rebalancing pressure, the inability of long-only commodity funds to roll their positions, all of that is its own lecture. But the point is, the system had a mechanical breakdown that was supposed to be impossible, and the people who were supposed to know better did not see it coming. I had a colleague, very smart guy, runs a commodity book, who told me afterward, "I knew the curve was broken, I just didn't know how broken until it broke." So, here's what I want you to take away from those two snapshots before we go any deeper. The damage from cheap oil does not show up where you would expect. The textbook says consumers win, oil exporters lose, net effect ambiguous, probably positive for global growth. That's the shape of the answer everyone gets in the first week of an international finance class. The reality is closer to a slow motion margin call propagates through 5 different channels at once, and somewhere around month 9, something breaks that nobody was watching. Sometimes it's a Brazilian conglomerate. Sometimes it's a regional bank in Oklahoma. Sometimes it's a sovereign. Venezuela in 2017, though Venezuela had other problems. Sometimes it's a hedge fund. Once, briefly, in April of 2020, it was the entire WTI futures curve. Think about it this way. A forest, when it gets a slow, steady rain, is fine. When it gets a flash flood, the topsoil washes away, the root systems get exposed, and trees fall in the wind 2 months later that would have stood for another 50 years. The damage isn't the rain, The damage is the speed of the water and the way it scours the layer underneath. Cheap oil is a flash flood. It scours the layer underneath the visible economy. The trees, the consumer-facing economy, look fine. The damage shows up later. So here's what I want you to know by the end of this lecture that you do not know now. I want you to be able to name the channels. There are 5. The petrostate fiscal channel, the sovereign wealth fund liquidation channel, the high yield credit channel, the producer hedging channel, and the capex destruction channel, which is the slowest and the one that, in my view, matters most for the next cycle. 5 channels. We will get to all of them. I want you to understand why low oil is not symmetric to high oil in its effect on the financial system. There is an asymmetry there that does not appear in any standard textbook I have ever seen. And I want you to walk away with a mental model for thinking about commodity prices as load-bearing financial infrastructure rather than as input costs. The whole exercise is going to require you to do something a little uncomfortable. You have to stop thinking about oil as a thing that goes into your car. Think about it as a balance sheet entry. Think about it as collateral. Think about it as the implicit guarantee underneath roughly 15% of the global high-yield credit market at the peak. Think about it as the operating budget of about a dozen sovereigns. When you do that, the question, does cheap oil help or hurt the global economy, becomes incoherent. It's like asking whether a forest fire helps or hurts the forest. Helps the soil chemistry, burns the trees. The two answers do not sit on the same scale. I want to add one more thing before we move on. Some of you in this room are going to go work at firms that do exactly this kind of analysis for a living. You'll sit on a desk, you'll have a Bloomberg terminal, you'll have access to data that nobody outside that desk has ever seen, and you'll be asked questions that nobody has written a paper on yet. The reason I'm walking you through this is not so you can pass an exam. It's so that when oil hits 40 and the financial press tells you American consumers are about to get a windfall, you'll know what to actually look at. You'll know to pull up the energy high yield spread. You'll know to look at sovereign credit default swap pricing for the Gulf states. You'll know to check the Norwegian krone, which is a kind of canary in this particular coal mine, because Norway is the cleanest, best managed petrostate on earth. And when even Norway's currency is wobbling, you know the rest of the field is in trouble. That's the door we're walking through today. Stay with me. Right. So let's take the conventional view and put it on the table because I want to be fair to it before I take it apart. The conventional view goes like this. Oil is an input. When oil gets cheaper, the cost of producing more or less everything else gets cheaper because everything else in some way requires energy. Plastics, transportation, fertilizer, food, everything. And consumers, who are the buyers of all that downstream production, end up with more money in their pockets either because prices fall or because real wages effectively rise. That money gets spent. That spending stimulates demand. Demand stimulates production. The economy gets a tailwind. This is, I want to stress, not wrong. There is empirical work. James Hamilton at UC San Diego has spent most of his career on this question. Lutz Killian at the Dallas Fed has done a lot of careful decomposition of oil shocks into demand shocks and supply shocks. And the broad finding is that big oil price increases tend to precede recessions. Big increases. The relationship for decreases is much weaker, much messier. And that asymmetry, by the way, is the whole story of this lecture. Hamilton noticed it. He wrote about it. He didn't fully explain it, in my opinion, but he saw it. Killian's work is worth pausing on for a second because it's the most rigorous attempt I've seen to take apart what an oil price move actually means. His point, simplified, is that not all oil price changes are the same. A price drop driven by collapsing global demand, like 2008, is a recessionary signal. A price drop driven by a supply surge, like 1986 or 2014, is a different animal. They look the same on a price chart. They are not the same. And the macroeconomic literature, until pretty recently, was just running regressions on the price level without distinguishing the cause, which was, a problem. Okay, so why doesn't the consumer welfare story work the way it's supposed to when oil falls? 2 reasons. And I'm going to give you the surface answer first, the one you can find in any decent macro textbook. And then I'm going to give you the deeper answer, which is the one that actually matters. Surface answer. The consumer benefit from a $40 oil price arrives on a different timeline than the producer pain. When oil drops to 40, gasoline prices fall, but they fall slowly. Refiners, distributors, and retailers all have inventory at the old price, hedges in place, contracts to honor. The consumer does eventually see the benefit at the pump, maybe 2 months later, maybe 3. By contrast, the producer side feels the pain almost immediately. A shale producer in the Permian who is drilling at a $60 break-even loses money on every barrel pulled out of the ground starting tomorrow morning. The asymmetry in the speed of transmission is part of the answer. Okay. That's the answer in any textbook. Here's the deeper one. The consumer side of the response is a small effect on a very large base. The producer side of the response is a large effect on a smaller base. Let me make that concrete. Suppose oil falls from 80 to 40. The American consumer, on average, saves something on the order of $700 to $1,000 a year, depending on how much they drive. There are about 130 million households. So total annual savings, plausibly, $90 to $130 billion, spread over 12 months, spread thinly across the entire consumption basket. Most of it doesn't even get saved or spent in a way that creates a measurable macro signal. Some of it goes straight into Amazon and DoorDash. Some of it pays down credit card balances. Some of it just disappears into the noise. Now look at the producer side. The American oil and gas industry, at peak, was generating something like $500 billion a year in revenue. A 50% oil price drop cuts that, roughly speaking, in half. $250 billion of revenue gone. That's not spread over 130 million households. That's concentrated on, give or take, 3,000 companies, many of which are levered, many of which have bond covenants, many of which have credit lines tied to the value of their reserves, which gets reset in the industry's parlance at the borrowing base redetermination, which happens twice a year. October, April, mark those months. Things break in October and April when oil is falling, and the workforce concentration is even more extreme. The American oil and gas industry is geographically clustered in maybe 4 states: Texas, Oklahoma, North Dakota, Louisiana. When energy revenue collapses, those state economies don't get a tailwind from cheaper gas at the pump. They get a labor market crisis. Houston in 2015 and 2016 lost something like 70,000 energy jobs. Local restaurants closed. Property prices in certain neighborhoods fell. The Dallas Fed put out a regional report at the time, in 2016, I think, that essentially showed Texas in a single state recession while the rest of the country was growing at 2%. The consumer benefit and the producer pain are not just different in magnitude. They land in different places. So you have a diffuse, slow, modest tailwind on one side, and a concentrated, fast, severe headwind on the other side. They don't net out the way the textbook says they will. Now, let me tell you something I'd probably get in trouble for saying publicly, but in this room, look, the reason this asymmetry is not in the textbooks is partly because the textbooks were written by people whose careers were built before financial sector risks dominated the macro picture. The transmission channels we're going to talk about today did not exist at scale in 1985. The high-yield energy bond market, as a major asset class, is a phenomenon of the 2000s. Sovereign wealth funds large enough to move global asset prices are mostly post-2005. The shale revolution, which created a whole new category of high-cost American producers, is post-2010. The textbooks were written before the wiring was installed, and the textbooks haven't caught up. That's not an indictment, by the way. It's just a reality of how academic literature lags institutional practice. The data on energy debt issuance from 2005 to 2015 is striking. The amount of oil and gas paper sitting in mainstream high-yield indices grew by something like a factor of 4 over that decade. 4. And by 2014, energy was the single largest sector in the U.S. high-yield market by face value, roughly 15%. So when oil collapsed in late 2014, you didn't just have an energy sector problem. You had the largest sector of the high-yield market repricing, which dragged the whole index down with it, which forced selling across all kinds of unrelated bonds. The default count from that episode is also worth knowing. Between 2015 and 2017, something on the order of 150 North American oil and gas companies filed for bankruptcy. 150. Aggregate debt of those filings, north of $100 billion. That is not a sector hiccup. That is a wave of default activity that, in any other industry, would be described as a cascading collapse. In oil and gas, it was, Tuesday. The market absorbed it because the rest of the credit complex was strong enough to act as a sponge. But the sponge has limits. You take that fact and you combine it with what we just said about the asymmetry in transmission speed, and you have the makings of what I'm going to call, for the rest of this lecture, the petrocredit asymmetry. Cheap oil is good for consumers in a small, slow, diffuse way. Cheap oil is bad for producer credit in a large, fast, concentrated way. The two effects don't cancel. The credit effect dominates the macro picture in a way that the consumer welfare framework cannot capture. Now, some of you are going to say, wait, but the consumer benefit shows up over many years. The credit damage is a one-time hit. Surely, over the long run, the consumer wins. Maybe. In an isolated experiment, maybe. But the credit damage is not a one-time hit. The credit damage triggers second-order effects, capex destruction, employment losses in the energy supply chain, the wipeout of equity in oil exporting emerging market economies, sovereign wealth fund liquidation pressure on global asset prices that propagate for years. The consumer benefit lasts as long as the price stays low. The credit damage compounds. There's also a thing that happens with the dollar that breaks the textbook story. Oil is priced in dollars. When oil falls, oil exporting countries earn fewer dollars. They have fewer dollars to recycle into the U.S. Treasury market. Treasury yields, all else equal, go up. Mortgage rates go up. The cost of servicing American consumer debt goes up. So there's a perverse channel where cheap oil tightens American financial conditions through the dollar funding market, and that tightening can offset some of the consumer windfall. Nobody penciled this into the textbooks because nobody, in the era when the textbooks were written, had a coherent picture of how Asian and Gulf state treasury demand actually affected the long end of the U.S. yield curve. This is the thing that, if you remember nothing else from this lecture, you should remember. Cheap oil is not symmetric to expensive oil. The downside, beneath a certain level, sustained, is structurally larger than the upside. The consumer welfare story is true at the surface and false at the level that actually drives the cycle. That's the foundation under siege. Let me show you where it actually came from. Okay, let me tell you a story that is in nobody's macroeconomics textbook. Or, well, parts of it are. The pieces are there, but nobody assembles them in the order I'm about to assemble them in. It is 1985. The Soviet Union is on top of the world, geopolitically speaking. Or not quite on top, roughly co-equal with the United States. They have a huge military. They have a sphere of influence that extends from East Germany to Vietnam. They have an industrial base that, on paper, looks formidable. What they also have, although not many people in the West fully understood this at the time, is a hard currency crisis hidden beneath the surface. The Soviet economy doesn't produce much that anyone outside the Soviet bloc wants to buy. There are exceptions. Vodka, sort of. Caviar. Some defense exports. But by far the largest source of Western hard currency for the Soviet Union is oil and gas exports. By the early 1980s, hydrocarbons account for something like 60 to 70% of all Soviet hard currency earnings. That money pays for grain imports because Soviet agriculture is broken. It pays for technology imports because Soviet civilian industry is mediocre. It pays for the loans they're servicing in Western banks. In 1985, oil is trading at, give or take, $30 a barrel. The Soviet budget is built on that. Then a thing happens. Saudi Arabia, after years of cutting production to prop up the OPEC price, they had been the swing producer for most of the previous decade, decides it has had enough. Their share of the global market has been crushed by cheating from other OPEC members and by the rise of non-OPEC production, especially the North Sea. So, in late 1985, the Saudis flipped the strategy. They stopped defending the price. They opened the taps. Production goes from something like 2 million barrels a day to over 5 million in a matter of months. The price, predictably, collapses. By the middle of 1986, oil is at $10, down from 30, two-thirds of its value gone in less than a year. For Saudi Arabia, this is painful but bearable. They have low production costs, they have currency reserves, they have allies, they can survive a year or two of low prices to discipline the cartel. For the Soviet Union, this is a catastrophe of a kind they have no language for. Their hard currency revenues collapse, they cannot pay for their grain imports without taking on more debt. They cannot service their existing debt without rolling it over at progressively worse terms. They cannot subsidize their satellite states the way they had been. East Germany, Poland, Hungary, countries that had been getting cheap Soviet oil and selling it on the world market, or that had been getting subsidies in other forms, start running into their own crises. Yegor Gaidar, who later became the first prime minister of post-Soviet Russia, wrote a book about this. The argument of the book, which was published, I think, in the early 2000s, is essentially that the Soviet Union did not collapse because of communism, did not collapse because of Reagan, did not collapse because of Afghanistan. Those things contributed. Sure, it collapsed because in 1986, the price of oil fell by two-thirds, and it never fully recovered before the political system gave way. Gaidar's argument is contested. Other historians don't fully buy it. But anyone who has actually looked at the Soviet hard currency accounts from 1986 to 1991 has to grapple with what those numbers show. And what they show is a regime running out of money in real time. There's a parallel story I want to mention here that almost never gets told together with the Soviet collapse, but should be. 1982, Mexico. The Mexican government, after a decade of riding high on the back of the 70s oil boom, hits a wall. Oil prices have started to soften. Mexico has accumulated, $80 billion of foreign debt. Much of it dollar-denominated, much of it floating rate. Paul Volcker has jacked up American interest rates to break inflation. Mexico's debt service costs are exploding while its oil revenues are flatlining. In August of 1982, Mexico tells its creditors it cannot service its debt. The Latin American debt crisis kicks off. Most of the major American money center banks, Citi, Manny Hanny, Chase, are technically insolvent if they have to mark their Latin American loans to market. The federal regulators, the Fed under Volcker and the OCC, basically tell the banks, don't mark to market, we're going to forbear, we're going to pretend these loans are good while you slowly write them down over a decade. That episode, which is sometimes called the lost decade for Latin America, is, at its root, an oil story. Falling oil prices, plus rising rates, plus dollar-denominated debt, equals sovereign default cascade. The 1982 crisis is the prequel to 1986. So that's collapse number one, 1986. Cheap oil ate the Soviet Union from the inside, with a Mexican appetizer in 1982. Move forward to 1998. The Russian Federation, the post-Soviet successor state, is heavily dependent on oil revenue. just like its predecessor. Oil is trading in the high teens for most of 1998. Russia is also caught in the contagion from the Asian financial crisis, which started in Thailand in 1997. Capitals fleeing emerging markets. The combination, cheap oil plus an EM capital flight, overwhelms the ruble's defenses. In August of 1998, Russia defaults on its domestic debt and devalues the ruble. The default sends shockwaves through the global financial system. Long-term capital management, the famous hedge fund, blows up partly because of positions that were exposed to Russian risk. The Federal Reserve has to organize a private sector bailout. So Russia's 1998 default reaches all the way into the heart of American finance. That's collapse number 2. Cheap oil weakens an oil-exporting sovereign. The sovereign defaults. The default propagates into Western financial institutions through hedge fund leverage. Now the third one, 2014 to 2016. This one, some of you remember. Oil is trading north of $100 in mid-2014. By February of 2016, it has fallen to about $26, a 75% decline in 18 months. The American shale industry, which had been built on the assumption of $70 oil more or less indefinitely, gets gutted. Energy high-yield bond defaults spike, that wave of 150 E and P bankruptcies I mentioned earlier. Saudi Arabia and Russia get into a price war. Saudi reserves fall by about $150 billion in less than 2 years. The Saudi government, and this is the part that nobody outside the region quite registered at the time, has to begin a massive austerity push. They cut subsidies. They float plans for a Saudi Aramco IPO, which they had previously refused to consider. They start the entire Vision 2030 program, which is essentially an admission that the kingdom cannot bet its future on oil revenue alone. Venezuela is the dark mirror of the Saudi case. Same shock, no buffers. Venezuelan oil revenues collapse in 2014 and 2015. The Maduro government, having spent the previous decade on Bolivarian transfers and price controls, has nothing in reserve. The country enters one of the worst peacetime economic contractions in modern history. GDP cumulatively contracts by something like 75% over the next several years. The bolivar undergoes hyperinflation. Several million Venezuelans leave the country. The ruling regime survives, barely, by abandoning every economic principle it had previously claimed to hold. That's a cheap oil collapse, even if other factors made it worse. Iran, separately, in the same window, is dealing with sanctions plus low prices, which is a brutal combination. Their fiscal break-even was already very high, well over $100. Cheap oil plus sanctions hammered their reserve position and drove some of the political volatility you saw in the late 2000s. Different story, same underlying mechanism. That's not a collapse exactly in the case of Saudi Arabia, but it's a regime restructure, and the trigger was cheap oil. I want to digress for a moment because there's something about the 2014 to 2016 episode that I think is more important than people realize. I had a conversation, this would have been, I want to say, the spring of 2017. I was at a conference in Singapore, and I had dinner with a guy who had spent most of his career as a credit analyst at one of the European investment banks covering Gulf sovereigns, and he said something to me that I have never forgotten. He said, the Saudis are fine, but the system the Saudis are part of, the post-1973 petrodollar system, the implicit deal with the United States, the stable Gulf, the OPEC swing producer model, that system is over. It died in 2014. We're just watching the funeral now in slow motion. And I remember pushing back on that. I said, look, oil could rebound. There could be another super cycle. He said, sure, prices can do anything. But the deal that was built around prices being $80 or higher, that's gone. And, I mean, you look at where we are now. Aramco is publicly listed. The Saudi Sovereign Wealth Fund is investing in everything from electric vehicles to soccer leagues to American gaming companies. Russia and Saudi Arabia have been managing prices together, more or less, in the OPEC Plus arrangement, which would have been unthinkable in 1985. The whole structure has shifted. He was right. 2014 was a regime change. We just couldn't see it from inside the moment. There was a fourth episode, smaller in scope but maybe more revealing of the plumbing, in April of 2020. Oil briefly went negative, as I mentioned earlier. That was, in some ways, the cleanest illustration of the points we're going to develop in the next two sections. The price went negative, not because demand had truly cratered to zero, although it had fallen sharply due to the pandemic, but because the financial structure of the oil market, the futures curves, the storage logistics, the ETF holdings could not absorb the shock. The price became a financial artifact divorced from the physical commodity for, a couple of hours. That episode, brief as it was, told you something important. The oil market is no longer a commodity market with a financial overlay. It is a financial market with a commodity input. And when the financial structure breaks, the price can do anything. Okay, so 3 crashes, plus the 2020 episode, plus a 1982 prequel. Different kinds of collapse, different transmission mechanisms, Soviet hard currency, Mexican sovereign default, Russian sovereign default. Saudi fiscal restructure, Venezuelan total collapse, American shale bankruptcy wave, April 2020, futures market breakdown. What do they have in common? Cheap oil applied for long enough, sustained beneath some critical level, breaks something in the financial political infrastructure of an oil exporting state, or the financial infrastructure that prices the oil itself. Every time, every single time we've run this experiment in the modern era, something has broken. The interesting question is, what is the level? And what is the duration? And what breaks first? That's section 4. So, let me give you the surface mechanism, the first layer. We're going to build this from the ground up so that anyone, including a bright high school student, can follow along, and then in the next section we're going to go underneath it. Here is the thing that almost nobody outside of energy finance fully understands. There are 2 break-evens for an oil-producing country. There is the production break-even, what does it cost to actually pull a barrel out of the ground? And there is the fiscal break-even, what does the government need oil to sell for in order to balance its budget? These 2 numbers are very different, and the gap between them is where the entire mechanism we're going to talk about lives. Saudi Arabia, take Saudi Arabia. The production break-even for Saudi oil is, depending on the field, somewhere between $3 and $10 a barrel. They have the cheapest oil to produce in the world, by a wide margin. The Saudi government could, in principle, sell oil at $20 a barrel and still make a profit on each barrel pumped. But the Saudi state isn't trying to make a profit per barrel. The Saudi state is trying to fund a country. That country has, last numbers I saw, and these get revised every year, about 35 million people. It has a huge military. It has massive subsidies on water, electricity, fuel, food. It has a royal family that, depending on how you count, has somewhere between 2,000 and 7,000 members, all of whom are doing fine. It has a development budget that includes building a city in the desert called Neom that is going to cost, when all is said and done, nobody really knows, but a lot. To fund all of that, Saudi Arabia needs the price of oil to be roughly, and this number floats somewhere around $80 a barrel. That's the fiscal break-even, the number where the Saudi government can balance its budget. If oil is at 40, the Saudi government is operating at a fiscal deficit of something on the order of 15% of GDP, which is enormous, which is unsustainable for more than a few years. They have to do something. They can draw down reserves. They can borrow on international markets. They can sell sovereign wealth fund assets. They can cut domestic spending, which is politically dangerous in a country with a young population and a labor market that has structural unemployment problems. They will do all of those things in sequence. And each of those actions has spillover effects on the global financial system. Russian production break-even is harder to compute, but call it $20 a barrel, roughly. Russian fiscal break-even, somewhere around 70. They need oil at 70 to balance the federal budget without dipping into reserves. At 40, they're hemorrhaging. Iran, production break-even low, fiscal break-even, depending on whose number you use, somewhere between $90 and $120. Iran is structurally an oil-dependent state and has been since the 1970s, with a fiscal regime that has never really adjusted to the volatility of the underlying commodity. So Iran at 40 oil is in a state of acute fiscal stress all the time, which is part of why their politics are the way they are, but that's a different lecture. Now let me give you the counterexample because it sharpens the point. Norway. Norwegian production break-even for offshore North Sea fields is, somewhere in the 30s or 40s depending on the field. Norwegian fiscal break-even, about $45. Could even be lower depending on the year. How? Because Norway, in the 1990s, did something almost no other oil exporting country did. They built a sovereign wealth fund and locked it in legislation. The fund, originally called the Petroleum Fund, now called the Government Pension Fund Global, currently manages something like $1.5 trillion of assets. Norway's fiscal rule says you can spend no more than 3% of the fund's value in any given year, regardless of oil revenue. So when oil collapses, the Norwegian budget doesn't collapse with it. The fund acts as a permanent buffer. They sterilized the boom. They built the pipe before the rain came. Nobody else did that. Russia tried sort of with their national wealth fund. The Saudis tried sort of with their public investment fund. None of them have the discipline of the Norwegian model. So Norway is the canary I mentioned earlier, but Norway is also the proof that this is a problem of institutional design, not geological destiny. Okay, so you have these countries with fiscal break-evens above 40, plus Norway as the well-managed exception. When oil is at 40, what do the others do? Let me give you the sequence. This is the sequence as it actually plays out, and I'm describing what I have watched happen, in real time, 3 or 4 times over the course of my career. Step 1, denial. The country tells itself and tells the markets the prices will recover. They keep spending at the old level for, 6 months. They draw down liquid reserves, treasuries mostly, currencies, money market funds. The first sign you see in the data is foreign holdings of U.S. treasuries by oil exporting countries starting to decline. This happened very visibly in 2015. Saudi Arabia's holdings of U.S. treasuries fell by something like $100 billion in 2015 and 2016. They were funding their fiscal deficit by selling treasuries. The Treasury Department actually changed its disclosure rules around this period, partly because of pressure to reveal Saudi holdings, which had been bundled with other oil exporters in the Standard Data series for decades. The fact that the disclosure had been opaque for 40 years tells you something about how politically sensitive that flow is. Step 2. They start tapping the sovereign wealth fund. The sovereign wealth funds of these countries, Saudi PIF, ADIA in Abu Dhabi, the Kuwait Investment Authority, GIC, in Singapore, which is not strictly a petrostate fund but plays a similar role, collectively manage trillions of dollars of assets, stocks, bonds, private equity stakes, real estate. When the home country's fiscal situation deteriorates, the sovereign wealth fund becomes a piggy bank. They start liquidating positions. The liquidation, by definition, hits global markets. It contributes to selling pressure in equities, in credit, in alternative assets. In the second half of 2015 and into 2016, there is pretty good evidence that sovereign wealth fund selling was a non-trivial driver of the decline in European bank stocks and in emerging market debt. There were specific episodes where you could trace flows out of certain Norwegian fund mandates and certain Gulf state mandates that lined up almost perfectly with sectoral sell-offs. None of this got reported in the press at the time. You only saw it if you were looking at the prime brokerage data. Step 3. They cut domestic spending. Subsidies get reduced. Public sector wages get frozen. Government employment gets trimmed. This is politically painful. In a country with a strong social compact built on oil-funded patronage, this is destabilizing. We saw it in Saudi Arabia in 2016 with the cuts to fuel, subsidies, and public sector bonuses. We saw it in Venezuela much more dramatically because Venezuela had no buffers. We see it in much milder form, even in Norway, which has the best managed petrostate finances on earth. Step 4, and this is where the thing leaves the country and infects the global system. The country devalues its currency. Pegged exchange rates are abandoned or weakened. The currency depreciates against the dollar by sometimes 20, 30, 40%. The Russian ruble in 2014 to 2016 lost almost half its value. The Nigerian naira got crushed. The Mexican peso, the Brazilian real, the Colombian peso, the Norwegian krona all dropped sharply. Currency depreciation in one major emerging market triggers capital outflows from other emerging markets, including ones that don't even export oil, because international investors get nervous about the asset class as a whole. The pegged currency dynamics deserve a closer look. The Saudi rial has been pegged to the dollar at roughly 3.75 to 1 since the 1980s. The Kuwaiti dinar is pegged to a basket. The UAE dirham also pegged. Maintaining those pegs in the face of falling oil revenue requires the central bank to actively defend them, selling dollar reserves to buy the local currency. So when oil falls, you get an additional drain on dollar reserves, separate from the fiscal drain, just to keep the exchange rate from breaking. The forward curves on these pegged currencies start to widen during oil collapses. Speculators start probing the peg. The defense is expensive. The Saudis successfully defended the rial peg through the 2014 to 2016 episode, but it cost them. And there were, briefly, some moments where the forward curve implied the market thought the peg might break. It didn't, but it could have. That's the sequence. Reserves first, sovereign wealth fund second, domestic spending third, currency fourth. And by step 4, you have a global problem. Now look, this is the surface layer. This is what shows up in the IMF reports and the Financial Times articles. Anyone who reads carefully can piece this together. Underneath this surface layer, there is something deeper, something that I think is the real story, and it has to do with how the sovereign wealth fund liquidations in step 2 interact with the high-yield credit market in the United States and Europe, and how producer hedging behavior creates a feedback loop that amplifies the price decline beyond what any economic fundamentals would justify. That's section 5. Let me get a sip of water. Everything we just talked about, fiscal break-evens, reserve drawdowns, sovereign wealth fund liquidations, currency devaluation, that's the visible mechanism. That's the layer that policymakers see, that journalists report, that academics model. Underneath that layer, there is a second mechanism, and it is the one that, in my view, actually does most of the damage. I'm going to call it the petrocredit reflexivity loop, because somebody has to name it, and that's as good a name as any. The loop has 4 nodes. Let me walk you through them. Node 1, oil falls, some exogenous shock, a Saudi production decision. Demand collapse, geopolitical event, drives oil prices down. They settle below the fiscal break-even for major exporters. $40 a barrel, give or take. Node 2, the energy high-yield bond market reprices. American shale producers, who issued enormous amounts of debt during the 2010 to 2014 boom, suddenly look much riskier. Their bonds get marked down. Their credit default swaps widen. Banks reassess the value of the reserves backing their loans. This is the borrowing base redetermination process I mentioned earlier, twice a year. At the bottom of the cycle, the banks come in and say, you have less collateral than you used to, we're cutting your credit line. The producer cannot meet its capital expenditure plans without that credit. Drilling stops. Bonds keep getting marked down because investors are looking forward, and forward looks worse. Let me sit on the borrowing base mechanic for a second, because it's the kind of detail that you only learn about by sitting on a desk. A reserve-based loan, which is the standard form of credit for an upstream oil and gas producer, is secured by the company's proven reserves. The lender, typically a bank syndicate, calculates a value for those reserves based on a strip price, the futures curve, with various discounts. The borrowing base is then a fraction, typically 40 to 60% of that calculated reserve value. When oil prices fall, the strip price falls, the calculated reserve value falls, the borrowing base falls. If the company's outstanding loan balance is now above the new borrowing base, the company is in violation. They have to pay down the difference immediately or over a few months, depending on the loan documents. They can pay it down by selling assets, raising equity, or, going bankrupt. Many of them, in 2015 and 2016, chose option 3. The bank syndicate becomes a forced seller of distressed energy assets at the worst possible moment. That's a credit cycle, but it's also a forced selling cycle that propagates through the entire energy debt complex. Node 3, forced selling spreads. This is the thing that nobody talks about cleanly because it's hard to see from outside. There are large pools of capital, pension funds, insurance companies, mutual funds, that have rules about credit quality. When energy bonds get downgraded from investment grade to high yield, certain holders are forced to sell. When energy high yield gets downgraded from B to B, other holders have to sell. The selling is mechanical. It's not based on the investor's view of the future. It's based on a rule somebody wrote in 1992 that says you can't hold bonds rated below a certain threshold. The mechanical selling spreads from energy into the rest of the high yield market because of cross correlations. Investors who hold a diversified high-yield portfolio see the energy portion of their portfolio crashing, and they sell other parts of the portfolio to manage their overall risk. That sells off non-energy high-yield. Spreads widen across the entire credit complex. There are also the ETFs. The high-yield bond ETFs, especially HYG and JNK, hold energy paper. When investors redeem ETF shares during a credit sell-off, the ETF managers have to sell the underlying bonds. The ETF mechanism creates a kind of exit that wasn't available in previous credit cycles. Bonds that, in the old world, would have been held quietly through a downturn now have to be sold whenever someone hits the redeem button on a brokerage platform. The structure of the modern credit market, with its ETF wrappers and its mark-to-market mutual funds, transmits price moves much faster and much further than the old buy-and-hold pension fund model did. That speed is not an unalloyed good. Speed plus mechanical selling equals fragility. Node 4. Producer hedging accelerates. Now this is the subtle one. Oil and gas producers hedge their future production by selling forward in the futures market. They sell, say, a 6-month forward contract to lock in a price for the oil they're going to pump 6 months from now. When oil prices are falling, producers, especially the financially weaker ones, get nervous. They want to lock in whatever price they can, so they sell more forward contracts. The act of selling forward contracts pushes the futures curve down further, which makes the spot price look even worse, which puts more pressure on producer credit, which causes more forced selling in the bond market, which reinforces the falling price expectation, which accelerates hedging. The volumes here are not trivial. At the peak of the 2015 hedging cycle, North American producers had hedged something on the order of 40 to 50% of their next 12 months' production. Those hedges, in aggregate, are worth tens of billions of dollars of notional exposure. The counterparties on the other side of those hedges are mostly the dealer banks, which then have to lay off their own exposure into the futures market. So the producer hedging chain ends up landing in the open futures market as systematic selling pressure on the back end of the curve. You can sometimes see it on the screens. You can see a wave of selling come through at certain price levels that corresponds, almost perfectly, to the levels where wheat producers had previously announced their hedging strategies. That kind of price action does not exist in a clean, theoretical model of commodity markets. It exists because of the financial structure layered on top of the commodity. That's the loop. Each node feeds the next. And critically, the loop runs at different speeds in different parts of the system. The energy bond market reprices in days. The forced selling cascade plays out over weeks. The hedging pressure builds over months. The fiscal damage to petrostates accumulates over a year or more, so the loop doesn't oscillate cleanly, it compounds. George Soros, who has written about reflexivity in financial markets for, 50 years, would recognize this immediately. The petrocredit reflexivity loop is a textbook Soros pattern. Falling prices change the fundamentals. They impair credit, they trigger hedging, they force liquidations, which then drives prices further. The market is not converging on a fundamental value. The market is, in effect, generating its own fundamentals. I want to stop and tell you something I've been chewing on for years, This would have been the late 90s, early 2000s. I was at a conference, and I sat through a panel where a guy from one of the big macro funds said, every commodity has a price at which it stops being a commodity and becomes a balance sheet event. For oil, he said, that price is whatever the marginal sovereign needs it to be. And the marginal sovereign keeps changing. In the 80s, it was the Soviet Union. In the late 90s, it was Russia. In the 2000s, it was the Saudi state and the American shale industry, jointly. Whoever the marginal sovereign or marginal producer is at any given time, that's where the system breaks first. I've been thinking about that ever since. Because what it implies, and this is important, is that the price level that triggers the cascade is endogenous. It moves. In 1985, the Soviet Union broke at $30. In 1998, Russia broke in the high teens. In 2015, the Saudi state and the American shale industry got severely stressed at 50. Why? Because the marginal sovereign and the marginal producer keep adjusting. Cost structures change. Fiscal needs change. Debt loads change. So when I tell you $40 is the threshold, I want to be careful. The number is approximate. The mechanism is what matters. The mechanism is there is always a price level beneath which the marginal sovereign and the marginal producer cannot survive. And at that price level, sustained, the system breaks. That price level today is approximately 40. In 10 years, it could be 50. It could be 30. The number floats. The mechanism does not. I should also flag the regional banking dimension because it's underappreciated. American shale is geographically concentrated, and so is the banking exposure to American shale. Banks like Comerica, Cullen/Frost, BOK Financial, certain divisions of regional Texas and Oklahoma lenders hold large concentrations of energy loans. When oil collapses, those banks see their non-performing loan ratios spike. Their stock prices crater. There were moments in 2016 when certain regional bank stocks were trading at multi-year lows, specifically because of energy loan concerns. The banks survived, by and large, because they had time to manage the workout. But you can imagine a sharper, faster oil collapse where a regional banking failure becomes the headline event. The Silicon Valley Bank episode in 2023 was, fundamentally, an asset-liability mismatch story driven by interest rates. But the structural lesson, that regional banks can be the transmission point for macro shocks, applies just as well to energy price shocks. We have been lucky so far that no oil-related regional bank has gone down. We may not always be lucky. Now let me give you the second hidden piece, which is the one that I think is the most important thing in this entire lecture. Capex destruction. When oil falls below the producer break-even, producers don't just stop new drilling. They cut their capital expenditure budgets across the board, equipment orders canceled, exploration projects shelved, services contracts terminated, long-cycle development projects, deepwater offshore, oil sands, complex international projects get pushed back 5-10 years. Specific numbers from 2015 and 2016 are striking. Global upstream capex fell from about $700 billion in 2014 to roughly $400 billion in 2016, almost half. A drop of $300 billion in 2 years in a single line item of corporate spending. The destruction of that capital expenditure is a delayed time bomb because the world consumes about 100 million barrels a day, and about 4 to 6% of global production has to be replaced every year just because old wells deplete. That's between 4 and 6 million barrels of new capacity every single year just to stand still. If you cut capex for 2 years during a price crash, you create a supply hole that doesn't show up in the data for 3 to 5 years. And then, when demand recovers, when the macro picture turns around, when consumers start buying gasoline again, there's no oil to meet that demand. Prices spike. The cycle reverses violently. We saw a version of this in the late 2000s. The capex destruction from the 1986 to 1999 era of low oil prices contributed to the supply tightness that drove oil to nearly $150 in 2008. We saw it again in 2021 and 2022, where the post-pandemic capex destruction, plus the politically driven underinvestment in fossil fuels through the late 2000s and 10s, plus the recovery of demand after lockdowns, plus, of course, the Russian invasion of Ukraine, set the stage for an oil price spike that nobody had penciled in. The 2022 spike was widely blamed on the war, but the war was a trigger. The setup was the capex destruction. So cheap oil today plants the seeds of expensive oil tomorrow. The reflexivity loop, played out at the scale of the global energy supply chain, is a generator of volatility itself. $40 now means, plausibly, $120 in 5 years. Sometimes. Not always. But often enough that it has to be in the mental model. Look, I know that's a lot. I know we covered a lot of ground today. But here's what I want you to walk out of this room with. Cheap oil is not benign. Cheap oil is a financial event. The transmission channels go through sovereign budgets, through sovereign wealth funds, through high yield credit, through producer hedging, through the global supply pipeline. Every channel is nonlinear. Every channel has feedback effects. And the textbook story, consumers win, exporters lose, Net effect ambiguous is, to put it as politely as I can, a partial truth that, at scale, is functionally a falsehood. Some of you, when you go work at firms that touch this stuff, are going to be the people who have to make decisions in the middle of the next oil crash. When that happens, I want you to remember the 4 nodes: reserves, sovereign wealth funds, high yield credit, capex, and the 5th thing, the thing the 4 nodes generate when they all fire at once, the violent supply side overcorrection 3 to 5 years later. That's the pattern, that's the cycle, that's the wiring, that's how it actually works. We'll pick this up with how to position around it next time.